In the shadows of war, inflation, and rising gas prices, a tremendous mega catastrophe is unfolding right now. Despite the fact that the American housing crisis prices were already out of control in the year 2021, we examined the most recent data to see what the future has in store for this country's crazy housing market. This video is for those who are in the process of purchasing their first house. We begin with the most obvious. As of late 2019, the average price of a single-family house in the United States was $389,000. By March of this year, it is $389, 30% growth in a little more than 2 years. The percentages are even worse in hot markets like Austin, Miami, Tampa, Phoenix, Las Vegas, and dozens of other emerging towns. Many people who predicted that this bubble would burst years ago are furious that it hasn't popped yet. When you're in the market as a buyer, it's natural to get carried away with your emotions. In terms of home prices, I've remained steadfast in my belief that this is just the beginning. Even if you don't want to believe it, there's a lot of proof suggesting rates won't go back to pre-COVID levels. This is the reality. For comparison, let's take a look at the previous housing bubble that peaked in July 2006. Observing pricing from the processing decade reveals something intriguing. Most people acquire homes using loans and pay for them with their income. Loan conditions and earnings fluctuate over time. Therefore, it's ridiculous to compare numbers based solely on this information. Investors, as may be aware, are currently confronted with a problem. The rate of inflation has reached its greatest level in more than 40 years. Stock market returns are expected to remain below 5% until 2035 because of relentless monetary tightening by the Federal Reserve. Reorganizing your holding in the stock market has never been more challenging or more important. So where do you go from here? Alternative investments are no longer optional. According to JPMorgan Analysis, accessibility to some of most popular alternative asset classes is now possible thanks to new technologies. This one stands out to me as an obvious choice. In this case, it's referred to as Masterworks.io. Masterworks.io is an art investing website. They provide you with access to their private assets from renowned artists such as Ben Sky, Monet, and others for a price that is tiny percentage of what the wealthy spend to acquire these works of art. Most billionaires invest between 10 to 30% of their total assets in art as a way to broaden their holdings and protect themselves against inflation. Indeed, from 1995 to 2021, modern art outperformed the S&P 500 by 164% and has the lowest connection to stocks of practically any major investment class. 3 artworks have been sold through Masterworks.io since 2020 with a net of IRR of 30% on each. They generally sell out within hours of launching new products with a 30% or more increase in revenue. That's amazing! If you're interested in getting on the first level, all you should do is visit masterworks.io, create a new account, look around, and make investment. Let's get back to housing for a moment. With my pricing argument, this is where I wanted to go. Over half of all American households earned more than $50,000 in 2006. As of today, the average household income is $67,000 because average American now earns about 33% more than they did in 2006. Comparing pricing from the past is unfair. It doesn't end there either. The average interest rate on a 30-year mortgage was 6% from 2001 to 2006, more than twice as much, in fact, as what most people are probably securing right now. Rates have been around 3% for the past few years. Then, what exactly do you make all of this? So, comparing today's bubble to the prior one is a horrible idea. As you could expect, we ought to consider affordability. What purpose does it serve to compare anything if the data used to make the comparison is unrefined and outdated? So that we may gain a clearer perspective, we'll make the following assumptions. According to this scenario, let's imagine that in 2006, the Smith family was trying to purchase a home. Let's say that the Smith family has 2006 average salary of $50,000 and they purchase a property for $243,000 in 2006. Their monthly mortgage would be roughly $1,500 if these factors and a 6% interest rate were taken into consideration. The result of dividing that number by their average monthly salaries give us percentage of 36%. Purchasing a home in 2006 would require the Smith family to spend about 36% of their earnings on the purchase. This measures affordability. On the other hand, what about right now? What kind of picture does this figure paint of us? Are we nearing the 36% mark? Instead of making you sit through the tedious process of figuring it out, I'll just tell you straight up. Affordability now now is at 35%, which is extremely near to the maximum from the previous time given today's rate. According to the last time's result, we're in bubble and the bubble should be about to burst any moment. After all, I only walked you through the process for a few minutes, illustrating how prices aren't important and affordability is what we should care about. When affordability has been shown to par with past boom, it is logical to believe that the current bubble will burst soon, as has happened before. There are several flaws with this hypothesis. In order to fully grasp this issue, keep in mind the following. In comparison to what we see in multiple different markets across the country, folks spending 36% of their monthly salary on their mortgage may appear excessive. On the other hand, the average household income in Los Angeles is $63,000 and the average home price is $915,000. This indicates that the average LA households pays a mortgage of $4,700 but only has gross monthly income of $53,300. This is startling statistics indicates that the typical LA family spend more than 90% of its monthly income on the mortgage. I don't know how this is feasible. When viewed from a distance, Los Angeles market appears to be headed for a crash that should have occurred many years ago. It's absurd that someone could buy a home there financially. How can we explain this? On Reddit, where the LA forum has been a lot of activity, this question has been posed a lot. Questions such as youngsters who purchase a home in Los Angeles, what is your occupation, etc. Many similar posts exist, and the answer nearly always boils down to these two factors. Number 1, the wealthy. But this doesn't cover anything because the average salary in Los Angeles implies that the majority of residents make roughly $63,000 annually. What, therefore, accounts for the second discrepancy? To put it another way, it's the money you receive as a gift from your parents, which also know as an inheritance. It is safe to assume that this figure is even higher in Los Angeles County, given that the legal and general latest data shows that 43% of homeowners age 34 and younger receive financial assistance from family members. What's the point of all of this? What does this mean for the future of housing prices in the United States? There is no proof that 36% is the height of affordability in Los Angeles, which has a flourishing real estate market. It's possible that the prices may continue to rise across the country. When considering the market in Los Angeles, it is possible that may even triple yet still not fall. In terms of inventories, this is a major problem. Supply and demand are all that matter in the market. While demand is extremely high, supply is at all-time low. More than 2 million properties were listed for sale on the market in July 2019. Today, it's barely over 1 million, 2 times fewer than the average. Even though nobody wants to, you really can't blame them for wanting to sell their home. I can't even begin to describe how awful it is to be a buyer right now. Despite the fact that many homes receive several bids, they often sell for more than their listing price. Furthermore, we already have a rising problem that could have a long-lasting effect on the markets. It's a topic that is hardly ever brought up. As a financial tool, mortgages are surprisingly beneficial for consumers. They're 30-year loans with no penalties for paying them off early or refinancing to a lower rate if the rate reduces. A record number of people refinanced their mortgages in the past several years, taking advantage of the historically low interest rates available. The 30-year rate was about 2.5% last year. In the current housing market, that's unthinkable. As the interest rates rise, it's getting increasingly difficult to get a loan. It makes no sense for someone to sell their current residence, which has a 30-year fixed rate of 2.5%, and move into a new residence that requires a 5% interest rate. It's illogical from a purely economic standpoint. This indicates that anyone who secured historically cheap interest rates will almost certainly not sell their homes, which is one reason why inventory levels are so shockingly low. Only if this number significantly improves will things begin to shift for the better. This market will provide difficulties for youngsters for years ahead, creating a divide between those youngsters who own their homes and those who do not own their own homes. Certainly, it may be argued that the higher interest rates will slow the market, but exceedingly doubtful that the market could suddenly fall by 30% to pre-COVID levels. If you disagree, please share your thoughts in the comment section. If you liked the video, please show your appreciation by clicking the like button and subscribing to the channel. Get notifications for new videos by pressing the bell icon. Have a wonderful day till then, and I look forward to seeing you soon.